All right, good evening. Good evening, everybody. Welcome to the Options Foundations course. The exciting month of options in December continues. What better way to celebrate the holidays than with discussions on derivatives? We're going to give it a minute or two. I see a couple of people trying to get in. Thank you, Stephen. Can see and hear. Good evening to you as well. Another good market day today. What's going on? Oh, we're bullish. That's right. Some good things happening. I hope everyone's finding success. And if you're not finding success, I hope you're finding break evens. I mean, look, there's still things are still not all going well, but most things are going pretty well. Steven said, great market day. Good, good. Hi, Perry. Good to see you. Another minute. Some good discussions today, as there have been on Discord. A few people are really taking advantage of that, both taking advantage and helping to contribute. Your efforts, those of you jumping in there, are appreciated. I'm going to continue jumping in when I can. We're going to do a formal Thursday morning this week. Greg said, sold my AMD too soon. I hope you only sold that first part and kept some. Or did you sell the second part a little too soon too? Sometimes though, when we'll follow the plan, I'll sell half or a third, and then it'll go up higher, and I'm like, oh, there we go. And then I'll sell it, and it'll keep going. You're like, oh hell. Well, okay. If that's what we have to contend with, we can live with that. But I like that you're willing to address it. That's phenomenal. That's not common. Where when something goes wrong, the first thing you do is take accountability. That's important. That should be part of our mindset, where we first look to ourselves and be like, did you do this? And then if it wasn't us, then we kind of figure out, well, okay, if it wasn't me, then what was it? Was it the market? Did I miss that? Was it my system? Do I need to make an adjustment there? But I do the same thing, Greg. I'm like, okay, buddy, what did you do? This was you, right? And I'm like, well, okay, we'll see. Love it. All right, let's dive in. Welcome out everyone to the Market Watch Group Options Foundations. Today we are just shifting gears into selling options. Very exciting. It really changes the dynamic. Everything we've done up until this point has been from the perspective of a buyer, right? That's the building blocks. That's what I said. As we build into combinations and more sophisticated and therefore more complex option strategies, where we're putting a couple of different things together, and one's going north, one's going south, and we got to figure out what's the net direction. Uh, it's a little harder, but it's also much more conducive, or at least potentially conducive, to our posture. So whatever we think the market's doing, we have the ability to match it with an option strategy. Right now, options are pretty cheap. We're feeling pretty comfortable buying them. That's not always going to be the case. And the fact that it's not always going to be the case means we need to be comfortable understanding what is it, first of all, that might have us thinking about selling options. And number two, how do we go about doing it, right? How do we go about doing it? Somebody couldn't get in. I'm going to copy and paste. It says I might have put the wrong link in the 12/7 email. Is that? I hope I didn't, but if I did, my apologies. That might be the case. Anyways, I gave him the link. All right, let's dive in. Let's dive in. Here's the disclaimers. Here's the agenda. Today's agenda: number one, intro to selling options. What's going on with as an option seller? Number two, our first foray and introduction into selling options will be via covered calls. Yeah, covered calls. We'll talk about the risks and the rewards. Then we'll talk about a comparison of two different types of covered calls. We'll make sure that you understand the two different varieties. So whether you have a portfolio of stocks somewhere and you're thinking, you know what, if this market ever goes sideways, I want to be able to produce income from the equity that I have in my stocks, where I could get 1 to 2% a month, just creating income off of what I already own, right? So we'll talk about that versus, do I buy a stock to specifically sell a covered call on day one? Two different strategies. We'll talk about that. Then we're going to get into selling puts. Now, here's what's hard is selling calls when it's done with covered calls is a neutral to bullish strategy, but not a strong bullish strategy, right? If it's something that's strongly bullish, I don't want to put a cap on the trade. I'm just going to buy the stock or buy the option and let's let it run. It's those other times, sideways, slightly bullish, even bullish, just not strongly bullish. So we'll talk about cash secured puts, then we'll talk about naked puts, the reward to risks, and then a summary, and you'll have a much better sense about what it means to be a seller, and you will be prepared to move into the next section of our options foundations course, which will be talking about spread trading, right? Talking about spread trading. Okay. Number one, and I want questions, comments, whatever it needs to be. Whatever it needs to be. So Bob had a question. He said, I watched the last session and my TOS numbers are different than yours. Do they change for the analyze? Well, the numbers will change. We're going to get into the model, but they will, they'll definitely, I mean, the numbers will change constantly. Yes. Like the analyze, I mean, a lot of things in that are very dynamic. So ask me again when we get there if it doesn't make more sense. I love it. Steven said, you're in my game plan now. I love it. Definitions of selling options. So we started with being a buyer, and I don't love my slide. I'm looking at it now. Selling options. You know what? I'm going to stop this for 1 second. I don't know why I had that in there. Let me just put a period and then let's start this back up. It was confusing. I'm looking at, wait a second. Here's why I'm saying it is because we are started from the perspective of rights. As a buyer, you have the rights. Now you are taking on obligations. So the definition, selling options, you are the seller or the writer. You write the option contract. People are like, what do you mean you're the writer of the contract? Well, there's not a formal contract, right? Where there's terms and I mean, there are, it's within the standardized options agreement form that you sign, quote unquote, you sign it when you initial it or whatever you do through your platform. By initiating an options agreement, you are entering into contracts. You are essentially establishing that any contract you enter into through options will be guided by the rules and restrictions under that agreement. So now as a seller, right, we might actually be creating the contract. There is no contract as of now. If I have 100 shares of IBM and I decide to sell a covered call on it, there's not a covered call on that exists. I am saying I'm writing this contract and putting it out to the market. Now, who's going to be on the other side of that? Is there a buyer just waiting for me to sell a covered call? Yes, it's a market maker. Remember that the market maker's job is to maintain liquidity. So if you're like, I want to buy an option, he'll sell it to you. or she, if you want to sell an option, he or she will buy it from you. They're going to get on the other side of it until they can then, in the normal course of their duties, until they can essentially establish the market in a way that somebody else comes and either buys or sells the contracts that they're carrying, right? Okay. Why is this important? It's important for us to really get clear about that because we're moving from rights. I have the right to buy the stock, which means I can buy it, I can not buy it, I can let it expire, to obligations. Now what? Now there's a chance that if the option that you sell goes in the money at any given time, somebody could be like, you know what? I want to exercise. And when they do, it goes to the OCC. The OCC randomly assignment is when they say you drew the short end, you have to fulfill this contract. And now you are obligated. You can't be like, you know what? I changed my mind. If the contract is open, you are obligated to either buy the stock or sell it to them. And you might be thinking, well, wait a second. What if I don't own the stock? If it's a covered call, you own it and they're going to take it. If it's a naked put, you're obligating yourself to do something and you don't have anything under. That's what makes it naked. A covered call means you own the stock. You're covered by the ownership of the stock. A naked put means you got nothing. You sold the option. You're obligated by it. And that obligation is now coming to fruition. That's when these things can be dangerous. And they can be very dangerous if you don't know what you're doing. Hence us being here today to learn what we're doing. We want to enhance our financial decision-making by grasping the complexities. Remember, these are the building blocks to spread trading. So why spread trading? Well, spread trading allows us to cover ourselves without having to buy the stock, which is very expensive and reduces our leverage. So that's what we're trying to do here. Say, hey, you know what? I can accomplish. Now, if you own stock, if you have a good sized portfolio, that's a great way to get capital working for you. Absolutely. But we can actually do very similar things with additional leverage. And so we're going to we'll look to do so. The other thing that understanding why this is important to understand is it helps to mitigate risks and maximize opportunities through informed strategy selection. Learning a bunch of different option strategies. We don't be like, oh, you know what, today let's see here, roll the dice and it's a diagonal spread. And then tomorrow it's an iron condor. And then the next day it's a strangle. And there's some fancy names. But just because I can doesn't necessarily mean I should. So I want to make sure that that's a big thing that we're doing is saying, why? Why am I doing this? Why am I selling instead of buying? What's the most likely answer? Because the options are expensive, right? Right now, they're cheap. If you sell options right now, you're not getting paid very much for them. So it's like, right? So what are you thinking? You're thinking, if these options are cheap, I'll probably just buy as a speculator. If they're expensive, I'm going to switch gears, right? Switch gears, go the other way. Okay. Covered call. What is a covered call? Covered calls involve selling call options against an existing stock position. An existing stock position. So what we're doing here is we're generating income through premiums. It's an income strategy. Covered calls, income strategy. Naked puts, income strategy. You'll hear people say that. But here's the interesting thing. It's a bit of a misleading statement because income, yes, meaning premiums are incoming. So you get to keep them only if you're right. You still have to be right. Now we can create different definitions of what we think right means, but we can't sell a covered call and the stock drops and then we're like, oh, look, I still made money. Yeah, no, we have to be right. It's not guaranteed income. It's still speculative. Yes, good point. Bob says 100 shares of stock per each contract. That's exactly right. For us to have the ability to sell a covered call, we get to sell 1 call per 100 shares. You have 299 shares, buy another share so you can sell 3 contracts. What are we doing? We are selling calls against existing stock positions. What does that mean? It means if I own 100 shares of IBM and I think, God, you know what? IBM's just turned sideways here. It's not moving. Well, maybe I've decided I want to hold on to IBM because it's a long-term holding. I'm looking for some long-term tax benefits from gains, whatever it may be. I have the ability to generate income. Basically, I'm renting my stock out. I'll say, hey, well, we're going, look, risk profile, visual representation of stock ownership and a call. Let's just dive into it. Let me show it to you. Oh, everybody will be happy to know Thinkorswim is back up and running. I had to set everything back up. I had to redial in watch lists and indicators. But it's going. A remnant of PNC calls that we had talked about that did significantly well. Let's talk about in analyze. I'm going to use IBM as an example. Let's assume it's hard to use IBM because it is a very bullish stock right now. Right? But let's say IBM back in here. Right now it's trending. So we're like, oh, it's good. But if it stops trending, or right at a certain point, we might say, you know what? I don't think it's getting above 170. So let's say I own IBM at 140. Right? I own IBM at 140. So I own IBM at 100 and we'll say 150 even, so it doesn't look too outrageous. At 150, 100 shares. And what I'm thinking is it's not going to go above. Now, this is what my risk profile looks now. Stock goes up, I make money. Stock goes down, I lose money. Right? That's how it looks. No, they just said there was problems. They're like, oh yeah, we've heard about these problems. And by the time I talked to somebody, when I reinstalled it, it let me. But like on Sunday night, it's like your account's not qualified for Thinkorswim. I'm like, what the hell are you talking about? Oh, goodness gracious. All right. Selling the covered call. So let's dive in. Let's say I decide I'm going to go out to January. It's about 38 days. And I'm going to sell an out of the money option. I'm not getting very much premium for it. This is 3 points out of the money, and I'm only getting $1.19 for 38 days. What does it look like if I do it? Looks like this. I've capped it, right? It's capped. And when it says I'm making over $2,000, that's because I'm already making $1,400. I can only make from here to here, right? Why would that be good for me? Well, right now it's a little hard because look where this volatility is. This is the cheapest options have been an IBM for 3 years, I would imagine. Oh, look at that. I'm right. The cheapest they've been. So do the covered calls look attractive right now? No, not even a little bit. Why? Because the options are cheap. The options are cheap and you're trying to be a seller. If you want to be a seller, where should the implied volatility be? In the upper half. In the upper half. Anything less than that, you're not benefiting from selling the premium. That's probably one of the most important things I can convey to you is what makes us want to be a seller. There's 2 components. This isn't in my slides. Number 1, time. If I think a trade's lasting 3 to 9 days, I'm not going to get a lot of positive time decay benefit. If I think it's going to be 10 days or more, the longer it takes, the harder it is to make money, the more I want to put time on my side. That's number 1, time. Number 2, volatility. if volatility is medium or high, but not low. If volatility is low, I can build a better trade than a covered call. Facts, period. That's it, right? So remember what we're doing. We own the stock. We're selling the right to somebody else. Who? It doesn't matter. To the powers that be in the market. Somebody out there has the right. IBM is a poor choice, never gets to 50. Yeah, I mean, honestly, right now, there's not going to be a lot of things that are generating great premium. Unfortunately. Now, that doesn't mean it's a bad time to do them. It's just going to be lower your expectations. Now, when there is high implied volatility, is that like, oh, it's so great, now we can just sell premium? Well, remember what implied volatility represents: expectations. So if implied volatility is high, that means expectations are high. That means there's probably going to be big price movements, and that's why people are willing to pay more for the option. So, middle ground is good. If the implied volatility is off the charts, somebody thinks something's going to happen, and I don't want to end up on the wrong side of it. So there you go. What are the benefits of covered calls? You generate income, partial downside protection. How so? If I have a $50 stock and I sell a $55 call and I get $2 in premium for it, theoretically, what I've done is I've reduced my cost basis from 55 to 48. I've collected $2 per share in premium. So now I own the stock at 48 and someone has the right to buy it from me for 55. Why would they do that? Why would someone buy that stock for 55? Because it's higher than 55. If the stock, remember what we said, if an option is a penny in the money on expiration, they're going to auto exercise it. If there's an auto exercise and you have an in the money call that you sold, you are getting exercised at expiration. You're going to have to deliver the stock. If you already own the stock, great. They're going to take it from you, give you some cash. Now you're done. You don't own the stock, they're going to sell it on your behalf, and you're going to find a minus 100 shares, which means you're short. You've shorted it now. What does that mean? It means you eventually need to buy to cover. You have to buy the stock back. So if the stock keeps going higher and higher and higher, it's going to cost you more and more and more to replace it. And we don't want that, right? So we're not trying to, remember, you're not trying to do a covered call because you think the stock's going gangbusters. You're doing a covered call because you think it's a solid, steady stock. I can collect some good premium. That's what I'm trying to do. What are the benefits? Income generation, partial downside protection through lowering of cost basis, and I retain equity. I retain ownership. I will have to pay taxes on the short-term calls. Those are short-term trades. But the long-term is intact, so I can maintain a long-term gain if I have one. Okay. Comparison of covered call. Oh, no, sorry. Risks and rewards. Risks associated with a covered call. Limited upside potential. You're capped. That's the risk. That's the risk. Well, there's another risk too, and that is if the stock drops, but you have the same risk if you buy the stock. This is separate from just if you own the stock. If you own the stock and it drops, you're going to lose money. If you sell a covered call and you have a stock at 50 and you have a sell a call at 55 and all of a sudden it's at 90. This has happened in my career, bad times, where people are like, oh, the calls are selling for so much premium. I'm like, there's a reason. And they sell it, and then all of a sudden the stock, it was a pharmaceutical stock. I remember specifically. And their news came out, phase 3 clinical results. They were good. Stock closed at 48 one day. Next day it's at 105. Like, no shit, 105. And everyone's like, oh, how do I get that? You don't. You don't, right? What do you mean? Here's how you could get it. You could buy back your call. So you was at 48, you sell a $55 call and you get like $5 or $6 premium, which is outrageous, so high. And at the time it's like, oh, this is magic. This is phenomenal. But now the stock's at 105. So a $50 call, I'd have to buy it back for 50. I sold it for 500. I'd have to buy it back for 55. 5,500. I'd buy it back. with what prospects? Well, if the stock goes from 105 to 150, then I'm great. But if it goes from 105 back to 80, well, then I'm going to take a $5,000 loss, and then I'm going to take another $2,500 loss, and I'm going to quit trading and think it's rigged. So trade them in your IRA, no tax until you withdraw. Yeah, that's true. It's tax deferred. If it's a Roth IRA, it's tax free. That is true. There are worse problems, however. There are worse problems than having to pay. If you're paying taxes every year on your trading, you're welcome. When you're paying taxes every year on your trading, you're welcome. And hopefully you're still with the group. Can I define a covered call? Covered call. You're selling a call against a stock you own. That's what covers the call. If you sell a call without owning the stock, you're selling a naked call. That's a bearish strategy, and there's just no need for it. Naked puts, there is, and we'll talk about that. But selling a covered call, that's what it is you are basically renting the stock to somebody else who thinks your stock's going to go flying when you think your stock's only going to go sideways, essentially, right? So there you go. Okay. Comparison of covered call strategy. So there's two ways to go with these. Number one is a buy right strategy. You buy the stock, you write the call simultaneously, right? I've done one covered call, made $12. So you're 100%. Simultaneously buy the stock, sell a covered call. So I buy a stock at 48, I sell it at 50. Benefits, immediate premium income. I buy it at 48, I sell the call at 50, I get $2 for it. I get that. That means that instead of paying 48, I only pay 46. I've lowered my capital requirement. That's a benefit. So now I own the stock at 46. The stock is at 50. What do I want to happen in a buy right? Quite simply, I want to get called out. I'm okay if I don't get called out. Why would I not be called out? Because the stock didn't get above 50. So if the stock's at 49, I'm okay. I keep my $2 when it expires. When an option expires worthless, the person who sold that option keeps 100% of their premium if they're still around. There's a chance they may have closed already, but I'm just saying if they're still around. So yeah, right. That's I keep the stock. The stock is worth $1 more than it was, and I can do it again. I can say, oh, now I'll sell another $50 call. Maybe this time I get $3. Now my cost basis has gone from 46 to 43. Now if it goes above 50, I'm going to get called out. I'm going to make $7, $7 on 50. It's not bad, right? That's not bad. 14%. If I do 14% in 2 months, that's an average of 7% a month on that capital. Would you be okay making 7% a month on capital? Hell yes, right? And you get to do it again. Stephen, absolutely right. Even if I get called out, and this is where, this is way back, but the Thinkorswim, the founders of Thinkorswim, they had this little experiment. They called it the wall. They built this crazy technological setup in their offices in Chicago. This is back before Ameritrade bought Thinkorswim, so this is way back. But shit ton more than the banks are offering, Sandy, for sure. So in the wall, they would have people who would pay like 50 grand to come out and basically move to Chicago and come every day to their trading floor, like in the offices of Thinkorswim. It was pretty cool. But they basically did covered calls and naked puts and iron condors. The covered calls and the naked puts, they called it the Wheel of Fortune. What do I do? And here's what's funny is when you buy a stock or when you buy a call, you're buying the right to buy the stock. So people are like, oh, you buy options to buy stock. No, never. If I'm going to use options to buy stock, I'm not going to buy calls. I pay $4 for a $50 call. That means that my price for that stock is $54. Why didn't I just buy the stock for 50 when I first started? That's a better deal. Better yet, why don't I sell the $50 put? We're gonna move into that here in a second. This is a segue. Why not sell the $50 put? Now I collect $3. Now my price of stock goes from 50 to 47. That's what I want. If I'm going to buy stock, I'm going to buy it using naked puts. If I sell the put and it doesn't get put to me, I keep the premium and I do it again. If I can get $3 on a $50 stock, that's 6% for a month. A month. So if I do it 2 months in a row and then the third month it gets put to me, great. My cost basis is 3 months better already. Then what? Then I turn around and I immediately sell an out of the money covered call. I sell the out of the money covered call. I collect premium. If it goes in the money, I'm going to get called out. I'm going to give them the stock. And now I have all the premium plus any appreciation and I can start again. It's a great income strategy. If you have a larger portfolio and you want to get some money work, it's hard. I mean, if someone had a couple $100,000, you're not just going to go trade a couple $100,000, speculating on options. You're probably going to take 15, 20%, 30, 40 grand in speculative options. And then you're going to have, money that you're going to do equity-based strategies, selling puts, writing covered calls. So you're a miniature market maker. Yeah, we're trying a little bit. Yeah, you're trying to be the house, right? We're trying to be the house. If most options tend to expire worthless, what do? We sell them if it's advantageous. Legging in strategy. This is where you already own the stock. Whether you bought it a week ago, a month ago, 10 years ago, you own 100 shares or increments thereof. And you decided that you think what? Well, if you're strongly bullish, you're not going to sell covered calls. You're going to let it go and be bullish. If you're strongly bearish or bearish at all, you're not going to sell covered calls. You're just working really hard to break even, right? You're treading water at best. Most likely you're slowly sinking. You're going to do this when you're neutral to slightly bullish. Neutral to slightly bullish. The more bullish you are, the less likely you're going to do the strategy. What's the benefits? Well, you have more flexibility in timing. It also allows for potential stock appreciation before committing. So what would that look like? That would be if I were to buy IBM here. Now I wouldn't do it here because why? Because look how strong IBM is. We're in calls. Who's in calls on IBM with me? It looked great at one point today. Still looks okay. Not as good as it did earlier in the day, but okay. But if I buy the stock here, then the stock goes up and starts to come back down, right? So if I'm going to leg into covered calls, what's my strategy? The exact opposite. I'm buying down here, right? This is where we're trying to enter trades. Where would I leg into covered calls? When the stock is overbought and the stock's up here and you think this thing's just going to drop down. The stock is dropping. What's happened to the calls? You're locking your gains in. So that's what legging in would be. Personally, I'm more of a fan of buy rights. I like that better. But I will when I do a buy right, I start a buy right by actually selling a naked put. Okay. All right. Considerations. Buy right offers more immediate income, but you're committing all the capital up front. Legging in lets you, take some time, provides more flexibility, but you may miss out on the immediate premium. All right, let's switch gears now. What is the difference between a covered? Do I buy stock very often? Yeah. Not in my trading account as much. But I will own stock and I will do naked puts and covered calls. Most people can't do a naked put. Actually, you'd find, especially if you're trading like Interactive Brokers or Thinkorswim, although Thinkorswim maybe has changed and maybe it depends on Schwab. But in the day, Thinkorswim basically was like, you want to trade options? Sign here. and take responsibility for yourself. That's the whole thing. A naked put and a covered call are actually considered synthetically the same thing. Let me show you what that means. There's no way I'm going to end on time, just so everybody knows today. Just warning you now. Okay, so this is a risk profile for a interactive brokers don't have this pricing model, Sandy. No, they sure as hell don't. They sure as hell don't. All right. Now, what if instead of this, so if I were to change this to selling a 100 and what's my delta? 240, 28, 165. We got to lower the number of contracts. 97, 635. Let's make this 165. It's pretty close. Let me go back to 160. This is a covered call. This is a naked put. Let me give it a little more credit. Cash secured put is all CS lets you trade. So they haven't given you level 4 is probably what that means, which is fine. I mean, I don't think it would matter personally. I don't think you would find yourself leveraging to sell naked puts to get 25% margin rather than a cash secured put, which isn't working on margin. So I wouldn't be too concerned about that. But if you ever find that you're debilitated by, not having the capital because it's tied up on a cash secured put, that would be when you ask them and say, hey, at this point, the more experienced you get, you can always ask again. And when you ask again, they ask the same questions. How much money do you have? How much experience do you have? How much knowledge do you have? What is your objective? Everything we do is risky. That's how you want to think about it. They try to trick you to not give you options. When they ask your time frame, it's long. When they ask your risk tolerance, it's high. When they ask your knowledge, it's off the charts. When they ask your experience, it's up there as well. I tell people all the time, look, we're a team. We're a team, which means I'm allowing you to leverage me. Because we're a team, you can leverage my experience and my knowledge, and you can say that you are extensive and expert level. Make sure they give you the options. I used to tell people that all the time, and then they would tell the truth, and then they wouldn't get options approval, and they'd set themselves back 3 months because the broker's like, nope, not going to let you do it. And they're like, what? They're like, ask again in 90 days. Oh, all right. Let's keep going. Cash secured puts. You are selling put options with enough cash to cover it if it's exercised. So basically, the amount you would need to buy the stock, because you have to be prepared to buy the stock. If it drops below the put's strike price, it's going to get put to you. Sandy, right? She said it's a bit paternalistic. It's our money after all. Yeah, no, they're not worried about your money. They're worried about you suing them because the coffee was hot, right? They're like, I lost all my money. Why'd you let me trade these options? No, they're not gonna let you do that. They're gonna be like, oh no, here's this option agreement where you said you're an expert. And you're like, oh yeah, that's right. So yeah, I mean, it's funny because that's why they need some CYA to make sure that if you lose money, you're not going to come be like, well, you shouldn't have let me do it, because that happened back in the late 90s. That was happening. I mean, they really strengthened the margin process or the options process. So margin cash can't be used for cash secured puts. Correct. Correct. It cannot. How does a trailing stop work with a naked put? You can put a trail stop on anything that has a trade, right? So, but typically, trail stops would be either A, the opposite, or B, based on the price of the stock. So if I did a cash secured put and I was trying to protect it, I'm going to set a stop against the underlying stock. And if I'm going to trail it, I'm going to say, hey, the stock's gone from 80 to 90. Instead of having a stop at or below 78, I'm going to have a stop at or below 88 now, right? And so I can do those things, but we tend not to do as much of those with time strategies. But you definitely can. So we do require larger amounts of cash collateral. We always have to select the appropriate strike price. If I'm selling a put, what do I want to sell? I want to sell out of the money, right? I want to sell slightly out of the at or slightly out, close to the money. If you sell too far out, you lose benefits. So at or slightly out. So if I have a $82 stock, I might sell an $80 put, which means that if it gets put to me, if I liked it at 82 and I end up getting the stock put to me, the stock's going to be put to me at probably 77 because I'm going to get $3 for selling the premium and I'm selling an $80 strike price. That's the benefit here. Now, I'm going to tell you this right now. My preference is spreads. I would rather do a bull put spread than sell a naked put. I would rather do a bull call spread than a covered call. They are going to look the same. They are going to behave the same. They are going to require less capital from us. Are there, of course, some trade-offs that I don't get? Yes, of course. There's always a pawn, right? There's always something that I'm not going to get. And that's important for us to understand. So, all right. I'm not going to do an example of a cash secured put scenario, but I am going to compare naked puts with cash secured puts. What is the definition of a naked put? And this is where everyone's just like, oh, you sell a put without holding anything else, right? That's a naked put. A cash secured put is I have cash to cover it. A naked put, I only have 20 to 25% of the cash. They are going to still make you put some money in. And if it starts to go against you, they're going to start asking for more money. So if you've ever heard of a margin call, would be a margin call generated by an option trade. The stock starts dropping, your margin requirement's increasing. And if it crosses your threshold, they're going to be like, either drop money in the account, close the position, or we're going to start selling something. And they usually sell the absolute worst thing. What do I mean by that? They sell the thing with the most profit. They're going to sell your best trade. If you ever get into a margin call, they're going to sell your best trade. Bastards. Key components of our strategy. You are obligated to buying the underlying asset. If you sell a naked call, you are obligated to sell it, to sell the asset. But this is a put. When you sell a naked put, you are selling someone the right to buy. From who? From you. They're going to buy it from you. But if you don't own it, if you're naked, you don't own it, and they're going to put it to you, and that's what's going to happen. Limited upside, unlimited downside. You are limited to the credit you collect. If that stock drops, it could drop to zero. So it's nearly unlimited. That's what I should have had there. Nearly unlimited downside risk. Margin requirements are typically going to be 20 to 25%. That's the main comparison with a cash secured put. You could theoretically start more of these. Should you? Probably not. That's probably not necessary. There's no reason that we should. Oh, you should do something. No. What then would have you want to do naked puts? Let me tell you an ideal scenario. When we first got bullish again, early on, like the first couple weeks, things started getting better. Remember what was happening, right? What was happening with implied volatility? Anytime you're coming out of a bear market or any kind of a correction. So when we first thought things are getting better, now we didn't have a ton of time, right? But in here, we are going to do a whole lot more selling strategies than we are down here, right? Remember that down here, what kind of time frame for selling? I typically won't go more than 20 to 30 days, even as a seller. Remember that time decays exponentially. So we start off and we're slowly going. And then as we get closer to expiration, it falls off the cliff, right? So as a buyer, we want to be here to here and then out. As a seller, I want to get onto this little downward trajectory as quickly as I can. So some people are like, oh, I'll sell 4 months of options. And I'm like, why? They're like, the premium's bigger. Well, of course it is. Is it bigger? So 4 months, that's 16 weeks. Is it bigger than me selling a 4-week premium 4 times? No, it's not. You might get $5 for selling 4 months and $2 for selling 1 month. So I want to sell $2 for 1 month and then another $2 for 1 month and then another $2 for 1 month and then another $2 for 1 month. Now I got 8. Right? And if things shifted, I could get out and move on. I don't feel like I'm tied into the position. 20 to 30 days for me. At most 35. But typically 20 to 30 days. Great questions. Great questions. What do we have as components? You are obligated to buy the underlying asset. You are limited on the upside, unlimited to the downside. You have margin requirements and you need capital reserves. Reduces risk. Question mark. Is that on my slide? Reduces risk. Did I say reduces risk? I can't remember. We can reduce. No. Okay. Clarify if I missed something about reducing risk. Risks and rewards. Risks in selling puts. Again, 2 big things. Number 1, market decline. Number 2, obligation to buy the underlying asset. The smaller time frames. I don't think it necessarily reduces. I think it adds flexibility and improves the capital you collect. That's what I would say. Obligation to buy the underlying asset, market decline risk. What are the rewards? Income, opportunity to acquire stock at a discount. Okay, let's get to a recap. Oh, look at that. We're only 5 minutes behind. And questions have been coming. So get to your final questions. I'm going to recap. Covered calls offer income and some downside protection. Selling puts can generate income and provide opportunities to acquire stock at a lower price. And remember that selling puts is going to be a building block and selling calls is going to be a building block that moves us into option spreads. Effective risk management involves understanding the potential downsides of each strategy, implementing safeguards. Make sure you prioritize comprehensive knowledge of both covered call and put strategies, selling put strategies to make informed decisions, optimize outcomes. As we conclude our exploration of individual strategies, next session, we will delve into the dynamic world of option spreads, which, as I said, I believe offers a more nuanced approach to options trading. Sandy, have you had any luck finding an option pricing model that you can access? And you might just Google it. There may be some tools that you can find. But as we get into, if you're not on Thinkorswim, you want an option pricing tool. You want something that will help with that. I'm going to maybe look around and see if I can find something that I can provide to anyone who doesn't have access to Thinkorswim. They have one, but I'm looking. Got it. Okay. All right. Questions. Coming up next. Oh, I changed that. It's not that. That's not what's coming up next. It's option spreads. I didn't change that. I changed it here, but I didn't change it here. Option spreads. Bull call spreads. We're going to do verticals in the beginning. Vertical spreads. Bull call, bull put, bear call, bear put. And Steven is giving me a little bit of a shame. I know your name. Asking about the changes I'm embarrassed to say that I haven't fully checked. You have full license and liberty to pester me as necessary. I still owe you guys an analytics video. Yeah, so love it. Starting the next 100 spreadsheet. Looking forward to spreads. Fred said, love it. You should be, Fred. You should be. I love spreads. Spreads really give us a great ability to control reward and risk. We don't have any of these like, oh, unlimited anythings. It's a great ability to mitigate time pressures and volatility pressures. So I'm looking forward to it as well. I can't wait. Don't forget, it's going to be Thursday, same time as tonight, 8:30 p.m. Eastern time. Oh, very cool, and Sandy, very cool. Very cool. Any other questions for tonight? Let me know. Press, I get it. Press said, I'll be listening to this recording a few times. Lots I don't understand. It's funny because as I have gone through the 2 foundations classes, we did 3 months on trading foundations, and I want everyone here to weigh in. You guys will shape how we move into 2024. I felt like the foundations could have been a little bit shorter, and we could have covered a couple of things faster. Maybe not too much, but some. And I feel like the options could be longer. And in my mind, I'm thinking, should we go to a 2-month trading foundations, 2-month options foundations? I'm kind of leaning that way because I feel like I could take more time. I could take more time for options. I don't want to like necessarily rush trading foundations, but here's the good news. I have the first full foundations. So then it would be like an abridged foundations class. I don't know. I'm playing with that in my mind. Fred's like 2 months on options. Do it. Or provide specific resources. Okay. The people have spoken. I was leaning a little that way. I think I'm gonna look to a bridge. I think I'm gonna go 2 months. So for those of you joining on this first round, we're gonna Press. I appreciate that. He said provide articles, but he would prefer me. Love it, man. Let's do it. I think I'm gonna do that. Let's do 2 months trading foundations, 2 months options foundations. You know what? I don't know. I'm not going to have the ability. I got to figure it out. I want to give like maybe like a couple of sessions that we could just, I'm going to work on this. Let me play with a couple of things in my mind. I like what we're doing here, and I think it makes sense to split it up. So, okay. But for now, we're going to stick with this 4 weeks. It's going to feel fast, but I promise we will move into the more sustained version. Absolutely, 100% we will. All right, I got to run. It's good to see everybody tomorrow morning, 9:15 a.m. Let's talk about all these good trades that are going around us. I like how we're seeing things. I like what we're doing. It's a good December. It's good to see you all. Um, And as always, happy trading.